Welcome. In this video, we will analyze if Swftc coin will continue to rise. Don't forget to subscribe, like, and please watch to the end to understand. There was a strong downward trend visible on the chart, and price action has recently broken above this trend line, marking a significant breakout. However, this breakout has not yet been retested. Typically, a breakout above a descending trend line is considered a key signal for investors, as it may indicate a potential trend reversal. From a long-term perspective, a move above this trend line can be viewed as a highly positive development. In technical analysis, though, a breakout is often considered more reliable when it's followed by a successful retest. In other words, the price should revisit the broken trend line to confirm it as new support. This retest helps traders gain a clearer understanding of whether the breakout is sustainable. If the price pulls back to the trend line and bounces higher from it, it can be seen as a stronger buy signal, validating the breakout. However, the fact that no retest has occurred yet means the market has not confirmed this level as support. This leaves some degree of uncertainty. If the price continues rising without revisiting the broken trend line, it could potentially be a bull trap, a situation where the breakout lacks real support and may lead to a short-lived rally. For the breakout to truly prove its strength, the price needs to establish a stable base at or near the broken level. These kinds of breakouts and potential retests often generate heightened attention and anticipation among traders, as they may signal the beginning of a new bullish trend. That said, it's crucial to keep in mind that not all breakouts hold. Minor pullbacks near the breakout zone can sometimes suggest that the previous trend is still in control, and that the breakout may have been misleading. For investors focused on balancing risk and reward, such setups can offer significant opportunities. If a proper retest occurs, and the price holds firmly at the previous resistance now support level, it creates a positive technical signal. On the flip side, if the price returns to this area but fails to hold above it, the downtrend may resume, and long positions might need to be reconsidered. Another critical factor is volume. For a breakout to be considered strong and sustainable, it ideally needs to be supported by rising trading volume. A breakout on weak volume is often seen as less reliable and more prone to failure. Still, it's important to remember, looking at trend lines alone isn't enough. We must also consider other key metrics. So stay tuned and keep watching closely. Currently, according to the Elliott wave theory, the market is in the third wave phase. The Elliott wave theory suggests that market movements occur in a specific pattern, consisting of 5 waves that follow each other. The third wave is generally considered the strongest and longest wave. This wave often generates significant excitement and buying pressure among market participants, as it tends to experience a faster rise due to the results of the previous 2 waves. If the market can successfully sustain the third wave, it indicates the continuation of the trend and more upside potential. However, Fibonacci levels play a crucial role in the progression of the third wave. The Fibonacci sequence is widely used to determine the price levels at which the market may react. In this case, the price is currently stuck at the 2,272 Fibonacci level. Fibonacci levels, particularly the 2,272 and 3,272 ratios, are considered strong support and resistance points. The 2,272 level indicates that the price is facing a significant obstacle and is experiencing a pause. If the price can break above this level, the next target will be the 3,272 level. The 3,272 level typically signals that the wave is nearing completion and that a correction phase could follow. The most important factor to watch here is whether the price can break above this level. If the price breaks through the 2,272 level, it suggests that the bullish momentum in the market is strong and the market may continue to buy. This could lead to a fast movement toward the 3,272 level. The 3,272 level often triggers a market reaction or correction, so if the price reaches it, it could be a critical decision point for investors. This level is typically considered the peak of the last wave, and after reaching it, more caution should be exercised regarding the price direction. On the other hand, breaking through Fibonacci levels doesn't always guarantee a continued rise. Fibonacci levels are based on past price movements and can be used to predict potential price reactions, but these levels might not always hold in changing market conditions. If the price struggles to break through the 2,272 level, it could signal a pullback and a possible correction toward lower Fibonacci levels. Additionally, despite the strength of the third wave, potential divergences or other technical indicators at these levels could remind investors to remain cautious. If the price breaks through the 2,272 level, targeting the 3,272 level becomes highly likely. However, such moves generally need to be supported by volume. If the price approaches this level with increasing volume, it suggests that the rise may be more sustainable and healthier. On the other hand, a rise with low volume could create concerns among investors, and the price might experience a sharp pullback after testing these levels. In this context, the combination of Fibonacci levels and the Elliott wave theory can help investors understand potential market movements. However, it's always important to follow a careful risk management strategy. No single indicator in technical analysis is sufficient to make a fully informed decision. Multiple factors can influence price movements, and therefore, relying solely on Fibonacci levels or the Elliott wave theory can be risky for traders. In conclusion, the fact that the price is currently stuck at the 272 level presents an important test for the continuation of the third wave. If it breaks this level, targeting the 272 level is likely. However, investors should remain cautious, even if these levels are surpassed, and consider the possibility of price pullbacks. Monitoring Fibonacci levels in this manner is essential. Currently, a clear upward trend is observed in the RSI indicator. The RSI, or Relative Strength Index, is typically used to identify overbought or oversold conditions in the market. However, it can also help to understand the general direction and strength of price movements. In the current situation, the RSI has gained upward momentum and has formed an ascending trend line. This indicates that buying pressure in the market is increasing, and momentum is developing positively. When the RSI moves in an upward trend, it generally signals that the price will continue moving upward as well. A strong upward movement in the RSI suggests that buying pressure is still present in the market, and this can support the price. However, such an upward movement may also imply the need for a correction at certain levels. In this case, attention should be given to the level at which the RSI currently stands. When the RSI reaches certain levels, it is typically followed by either a touch or the possibility of a correction. In other words, at a certain point in the RSI's upward trend, the price may experience a period of horizontal movement or a temporary pullback before continuing further upwards. These situations may result in the RSI reaching a certain level, touching it, and then moving upward again. If the RSI finds support at this level and starts to move upward once more, this could be a positive signal for the price as well. This is because such movement in the RSI implies that buyers may be able to maintain their strength, and this strength could also be reflected in the price. For example, if the RSI defends its current level and begins to move upward again, this would confirm the continued buying strength in the market. However, it's important to note that the continuation of this upward trend in the RSI is not guaranteed. Market conditions and other technical indicators can affect how long the RSI can sustain this trend. If the RSI approaches a certain level and encounters resistance, it could potentially trigger a corrective move. In such cases, the RSI's previous ascending trend might break, which could put additional pressure on the price. On the other hand, if the RSI continues in its upward trend, the price's potential to move higher also increases. This is because the relationship between RSI and price is typically complementary. An ascending RSI often leads to the price trending toward higher levels as well. However, investors should also monitor whether the RSI is approaching the overbought zone. If the RSI nears the overbought region, it could be a warning sign, suggesting that the price may need to undergo a correction in the short term. Once the RSI touches this rising trend, the price will likely retest the trend it previously broke. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.